Today I have Tiffany Mittal, who is that pronouncing your name correctly? Mittal?
Yes.
Okay, excellent. So I should have asked that before, but yeah, on this show, we're just like bootstrapping everything. So I have Tiffany Mittal on the show, who is the founder of Utility Ranger and a multifamily real estate investor in her own right. So Tiffany, welcome to the show.
Thank you so much for having me on.
So I would love for you to give us just a snapshot of where you are right now in your multifamily investing and business journey, and then we'll dig into how you got there later.
Yeah. So my husband and I, we're multifamily investors. We recently relocated our whole family from San Diego, California to Stuart, Florida. And we have about 100 units in San Diego. We just bought our first 30 unit property in Pompano Beach, Florida. We closed on it last night, so we're pretty excited about that. And we started a tech company. We started a prop tech company really to service ourselves, but then realized there were a lot of other investors out there like us that needed it. So we decided to bring it to market. And, that's been going really well so far. So it's been quite a journey to get here, but it's been pretty amazing.
Well, we're going to dig into all of this over the next half hour or so, but I'd like to know about the kind of stuff that you were buying in San Diego, and to start off your career, because it's very often the case that you hear people say like, "Oh, you can't make money in California," or there's only two states in the world you should invest in, and they're called Florida and Texas, and like everywhere else is a hellhole. And which I hardly disagree with. I think you can make money literally anywhere in real estate if you understand the market and you know what you're doing. So I would like to hear about your investments in San Diego, and kind of what kinds of things you invested in, why you were attracted to them. So let's start there.
Well, I would say we had a little bit of a leg up more than most people. My husband's family, they're multifamily investors as well. They started buying properties and mainly kind of BC properties in Los Angeles County, back in the early 80s, all the way kind of through the 90s and continue to invest. They have a portfolio of about 3,000 units. And so my husband kind of grew up in the business. He would always say that, while all the kids were going off to, Club Med for summer camp, he was cleaning apartments. So they'd have a big owner operator property management company. And we kind of peeled off from that to focus on our own investments. But again, we had that leg up of experience from growing up in the business. I pivoted into helping my husband with multifamily. In about 2008, I actually had a different business and decided to go back to grad school and started helping him. So I kind of fell into it. And then I realized that operations is really hard. And if I had to deal with bed bugs and maintenance techs, like that just wasn't where I wanted to be. So I pivoted into prop tech to solve a problem that we had. But our main investments in California have always been the BC, type of investments, garden style, average 40 units, probably as small as we have a few duplexes even, but anywhere from duplex to 40 units has always been kind of our sweet spot. Many of our tenants are on Section 8 because everyone in California has to accept Section 8, which we used to kind of not look as fondly towards, I would say, although in San Diego, Section 8 kind of leads the market, which is not the case in many other areas. So you normally would get about a 10%, increase on market rent by accepting Section 8 tenants. But then through COVID, those Section 8 tenants really saved us because they didn't have the jobs and we were getting the direct deposit. And so we were really protected from an income standpoint during COVID. And so now we look at that much differently than we used to as a protected source of income. To a certain point, it's a little bit challenging still.
Yeah, so I'm very curious about this because I've never done Section 8 myself. I've always shied away from it. I know a lot of people shy away from it, but I've heard from the fans of Section 8 before this same kind of thing, that look, it's a basically guaranteed check. You don't have collections issues, right? You're going to get your money, but it is challenging though. So what are the challenges that you face managing Section 8 property that you don't have with a market rate property?
Well, I think a lot of people maybe look at Section 8 as, here's a Section 8 tenant, I have to take them. You still have to screen them. Are they a good fit for your community? Do what, you can't ask why they're on Section 8, obviously, and you can't necessarily make, decisions, but you have to also find a good fit for your community. So many of our Section 8 tenants, we actually have a lot of Chaldean residents who maybe came over in the early 90s after it's like a Christian Iraqi, and they came over after, the Persian, what war was in the early 90s? The
Yeah, the first
Desert
Persian Gulf.
Sand.
Yeah, the
Yeah.
Persian Gulf War. Yeah.
Yeah. So after that, a lot of people came over who maybe helped us and helped the troops over there. And what's really interesting is, they're wonderful tenants. And most of them are little old ladies. And as soon as we have another vacancy come up, one of their friends immediately has an application. And so I think it's choosing the right Section 8 tenant for your community. We've had struggles with a few. I mean, sometimes you get a bad seed, and that can be challenging. But even though it's challenging, they typically have a social worker, and it takes them so long to get on Section 8 in the first place.
Mm.
If there's a challenge, you go to their social worker, and their social worker typically solves it pretty quickly because that resident is so worried about losing it if, something's not going right. So I would say you kind of have, another person in your corner to help you through that process.
Are there any, sort of compliance issues that you have to be aware? Like if you're choosing your Section 8 clients, are there any things you have to be aware of to like not trigger some liability? I mean, I can imagine there must be, there's a normal like anti-discrimination laws and stuff that
Yeah.
apply, but I'm wondering if there's anything, like how do you go about sort of screening your Section 8 tenants without inadvertently tripping over one of the things you're not supposed to do?
I mean, you're still doing the traditional checks, right? So you'll see if something comes up on a record. Has there been any kind of eviction? Has there been any kind of other issue? So we go through our standard screening process, and you have to make a decision based on that. It's not necessarily so easy per se, but we get both Section 8 and market rate residents. So you have to make a choice based on your criteria, and everyone's criteria is slightly different. And not all Section 8 will pay the max amount for a one bedroom. Do they have another person living in there who has to come and help them? Or do they have a nurse who has to come and help them? Another person's living in there. Is it one person or two people in the unit? There's different kind of criteria you're going to go through. So it's not necessarily easy, but I say standardize your selection criteria, make sure you're not violating any rules in the process, and move forward with your the most, I would say, likely choice.
And then the property that you just closed on, the 30 unit in Florida, is that also a Section 8 property, or is that something like a
No,
totally different
so
direction?
it's so crazy how much more opportunity there is in Florida from California. And just to give you a sense of the challenges, or not maybe the challenges, but the differences between the two. So most of our properties in San Diego, let's say we could sell them all day long for 330 a door. And that's a C neighborhood, but maybe a C plus B minus property. Like we keep our properties really nice, we upgrade them. But out in Florida, and Pompano Beach is kind of an up and coming area, our model shifted a little bit. I always tell people you need to know your model, right? Like, what are you trying to do? So we had a certain model of kind of workforce housing, kind of bread and butter, and then we started accepting more Section 8 in San Diego. But here we wanted to change our model. So for 330 a door, that's a 4 cap in California. But here we could buy for 175 a door, a B plus area with a B minus property with maybe 2 Section 8 tenants. I think we have on the property. We just closed yesterday. So we're going through the rent roll. I think there's 2 Section 8 tenants on it. But but we're at a 7 cap, so it's half the cost we're upgrading our units. And our model here has changed because we've kind of seen what's happened in California as California has developed over time. One of the things of the criteria we're doing here is we have two big pieces of criteria. One, are they charging their tenants for utilities, right? So are they doing rubs on the property? That's like number one, because we know we can have an instant equity increase by implementing a rubs program on the property. Number two, we want to buy adjacent to new development, because we know as new development comes online, there's a ripple effect, right? So the property that we bought has a brand new Class A 350 unit apartment building being built. We share a fence with them. They're right behind us, right on the US 1. And so that kind of a development is going to have a ripple effect on our rents. On top of them not charging for utilities will also increase, on top of some other value add things that we'll do, new kitchen countertops, cabinets, flooring. But we'll do that over time as they start to turn over. So it's not so much capital output, but we're getting that lift, right off the bat with the utilities. And then as that development comes online, that should also have an increase for us.
So how does that work? I mean, I've heard like real estate brokers. I'm in New York City and I hear real estate brokers all the time. They'll tell us, oh, you should be so happy that this new development's coming in next to your building because your property values are going to go up, which is kind of counterintuitive because it's like, hey, there's more supply coming in. So how are our values going to go up because of that? But this is something they commonly say. So I'd love for you to explain how that process works.
Well, the way I see it, and maybe everybody sees it a little bit differently, but when a new development comes online, like we're not really looking for the same resident, right? The person who's moving into my, B property is not going to be moving into a brand new Class A development, two different markets. So they're not really competing with us, but what it does, it makes the rent comps within the close proximity go up tremendously, right? So then that ripple effect goes from, $1,700 or $1,800 a month to $2,000 a month, maybe $2,100, and maybe they're charging $2,500 to $2,700, right? Where if you were 2 miles away from that development, that ripple effect may not hit you, right? So it's more of the proximity of these other Class A properties means you're going to have additional development and kind of Class A clientele in the neighborhood that are going to kind of elevate the whole neighborhood.
And do you screen for this when you're looking for properties, or is this more of a process of like when you're out there, you've identified a property that you like and you go eyeball the neighborhood and you're like, oh, look, there's a new development right next door, that's going in. Like how does your process work?
So kind of both of those. So typically we had an area that's in Lantana, Florida, which is again a little bit more of an up and coming area that has this huge development going in of Class A shopping, Class A apartments, condos, housing, and this huge probably 5 to 10 acres of space, but the surrounding area is pretty gentrified and definitely probably struggling. But when you start having all this Class A shopping, and we were strategically looking at buying in and around this development within kind of a half-mile bubble because of this ripple effect. But every time something would come on the market, it was snatched up really quickly. I think other people are looking at this as a strategy as well. We actually did a 1031 exchange. So we sold 5 single family homes that were student housing that we had in California. That really hit the top of their market. My husband actually acquired those shortly after college, and he probably bought all of them for maybe $200,000 a door, or $200,000 for each of the homes, and we were able to sell each of them for close to $1 million. And so, but that market has been changing quite a bit. So we said, okay, this is the opportunity to sell these homes. We kind of feel like the stars aligned for us. There was a 1031 change of rules in California for this year only because they had a bunch of really heavy rains causing damages to a bunch of properties. So they extended all their 1031 rules rather than 45 days to identify, to close quickly thereafter. They said, as long as you close by October 9th or 12th, I don't remember the exact day, as long as you close, by the beginning of October, we're not going to worry about when you identified or anything else. So it gave us the opportunity, instead of selling the homes in a bulk sale, that we could sell them all individually at market rate and then bulk that money together to do one big 1031 to buy the 30
Mm.
units out here. So it was a perfect opportunity for us. And so we initially had a 30 unit property that we found off market through a broker that we were looking in the Lantana area with, telling her we wanted to buy a property. And she found a property that was on the water, actually in Stewart, where we were. And it had 8 boat slips, 30 units. It was a historic property. It really was amazing. We were really excited about it till we got into the due diligence. And then, it had a lot more construction needs than we were prepared to handle. It's a 100-year-old building. So it had a lot more kind of stabilization issues. There's a big kind of 40-year building certification that's kind of flowing through Florida. It's kind of more mandated south, but we know if it came into our town, that could become problematic. And so the deal got riskier for us. And so this deal that we just bought was our backup property
Mm.
in Pompano. And I always tell, if you're in a 1031 exchange, don't fall in love with one property, always have a backup property. And so we were fortunate the backup property was still on the market. It was $2 million less per unit. So that was great. So the numbers penciled out even better. But then when we went to tour the property, we just so happened to see the big development going next door. And we're like, oh, this fits our model even better. It has the development. It's, going to cash flow day one. And, you know, this is a much better deal for us, even though the other one was enticing, being waterfront and this beautiful historic building. I would say our business manager friend of ours, he gave me a little piece of advice that helped me kind of get over the, beautiful property that we wanted, was you don't have to hit a home run every time. You
Right.
just got to get on base, and you're not in a position in your, investment journey that you can take that big of a risk, because if it doesn't work out, that'd be too big of a hit on you. So, just get on base. And then when you're ready, you can take that big risk and buy that property that maybe is outside of your risk profile.
Right.
So that advice kind of helped us kind of pivot and take this deal, which is much more in our, I would say, business model of investing.
I mean, I always tell people, like, to fall in love with the data, not the deal.
Mm-hmm.
So it's similar to that. I mean, you need to kind of know what it is that you is right for you to buy right now, rather than that thing that's just, you fall in
The
love with it
shiny
because it's
object.
the shiny object that's beautiful. I mean, listen, I'm totally, I can relate to this because I'm like an architecture freak and a history freak. So I have trouble like saying no to stuff like that, but
I know.
you have
And it
to,
was
you have
so
to learn
outside
how.
of our model, but then you start making exceptions for your model, because it's like, oh, well, we could never find this on the water, or oh, there's all this other potential. We could put a rooftop restaurant on board because it had this restaurant license, but then when you really dug into the city permits, those things that were, said weren't really there. It may had been there in the past, but weren't there anymore. So
Right.
it just started getting a little hairier than we wanted to do. So we were lucky to have a backup property, and the backup property fits our model much better. And so, but it's hard not to steer and get distracted by these
Mm-hmm.
beautiful buildings. So
Yeah,
it's
you start thinking about how, how cool it would be to own it, right? That's kind of like, should be like a red flag in your mind as an investor. Like the minute you start thinking about how cool it would be to own this property, probably you should walk away from it,
I know it's that emotional, it's like starting to
Yeah.
get you emotionally involved with it. And they always say you can't be emotional with real estate, but it just comes in out of nowhere sometimes and tempts you.
Yeah, absolutely. So are you self-managing this property that you just took over?
So we were self-managing all of our properties in San Diego. And management is challenging. And so, but that's all we ever knew. That's how my husband grew up. It was always about self-management. But we knew we couldn't move. We knew when we moved to Florida that we wouldn't be able to manage our properties in San Diego. So we transferred to third-party management. We
Hmm.
chose a very well-known property management company, but that was very locally based. So they had maybe 5,000 units under management, but all of them were like in this one area. Our properties are in El Cajon, are this one area of San Diego that's very distinct in this kind of workforce housing area. So it was choosing the right manager, getting on the same page. What you would do and what somebody else would do is different, right? Like I remember right after we moved to third party management, 20% of our units all of a sudden needed new air conditioners. And we're like, whoa, like you don't need new air conditioners on 20% of the units all of a sudden. And it's because once the management changed, everyone started putting in work orders. But that's not how we would have approached it. We would have said, okay, what can be fixed in these air conditioners? And if they can't be fixed, we'll replace them. But if they can be fixed, we're not going to just replace them. So getting on the same page with that management company. But over time, they were doing better than we could have ever done. Just the systems and the processes in place on a much bigger firm were so much better than we could have done. And the amount of time that frees up for you to change your focus. And it's hard when you're a little bit of a control freak, when you're a self-manager, you want things done your way. But I actually heard this, I think it was on maybe the Multifamily Insights podcast. They had a woman on there talking about moving from self-managed to third-party management, and her advice. My husband and I happened to be listening to it in the car, a podcast, and she had said, and it really resonated with me, the means of control just change. So instead of focusing on all these little things like air conditioners that you can't really control, you really need to shift your focus to like where you want to invest, what type of asset do you want to invest in, and who do you want to invest with. So it's you still get the control, but you pivot to what kind of control are you doing. And so that really helped us kind of think of it differently. But we've never been happier since we moved to third-party management, freeing up our time to focus on our prop tech company. And then when we moved with this new property in Florida, we said, okay, we're not even going to bother with trying to self-manage. So we chose a similar type of management company that had a lot of area specific knowledge. So we went with them, and we'll see how that goes. Today is day one. So far, so good.
So one of the things I've always heard about operating properties that are in that size range is that it's difficult to find good managers, but that's something people talk about frequently. And also the underwriting is very different, right? Because you've got, say, maybe all of the labor is included in the management fee. So the management fee like looks really high, but then you're not paying labor. How do you underwrite the 33 unit, with the management fees and labor and stuff? How does it work out in your case?
Well, we interviewed a couple different management companies, and they were all slightly different. And I'll kind of go over why we chose the one that we chose. One of our management companies that we interviewed, we liked them tremendously. They had, I can't remember, maybe 800 or 900 units under management. They owned maybe about 150 of those. They managed for other people, and they had, a pretty robust system, but everything was contract labor, right? And then one of the things that he mentioned to us was that what they had learned over time is using all these contractors means all the individual property owners had to then 1099 each of these individual vendors. And at the 1099 time of the year, when you have to give out all these, it became a nightmare because you have one vendor and, however many management companies, 1099s all coming to the one vendor. So they created a separate LLC for maintenance, and all the vendors went through there. And then that one maintenance LLC did all the work for the property. I think there was a slight markup on that. And then we would only have one 1099 towards that one maintenance arm of the management company. And that sounded, logical, right? Because that's a lot of work when you start getting into vendor payments and stuff. But then when we interviewed another company, he said he had, 60 maintenance crew on staff, and they had cut a bunch, and he had grown up in the business too. So I think when you're in this kind of segment of the market, you have to be a little bit scrappy, you could say. You have to be able to kind of, bob and weave. And so he said he had his own team on staff. He does it that way so we can get kind of rock bottom pricing. He had a roofing company he had to deal with, that when their service time was slow, that he would hire their roofing team and then buy the roofing materials and use them to go re-roof whatever needed to be done in his portfolio, which is a little bit how my husband operated, right? So,
Mm.
how can I creatively get around all these problems and then use my own team to get the stuff done? That's, I think, one of the things that we liked about him. He had a team of
What's that?
the maintenance.
Yeah, last thing I heard was about how your husband also used like the crews creatively, like when they had slack time, he would use that vendor to do his roofs and stuff. And that was the last thing I heard. So what were you saying after that, after before you noticed that you had been cut off?
Uh, so other things that we looked at besides of creative ways to use your internal crews to make improvements or use them to kind of save money on the property level, is there was also no markup on the maintenance. So that was a helpful side of it.
Mm.
But then there's other things like, are you charging fees to rent the unit? You want to incentivize the leasing agent so they answer the text at 9 o'clock at night,
Mm.
right? So I understand a bonus, but there's different levels. One person would say that leasing agent would get $500 for a bonus to lease the unit, where another management company would say it's 1 month's rent. I mean, that's a pretty big difference.
Yeah.
And so, how those fees really pan out, the overall fees of kind of gross revenue on the property were pretty similar. I've seen anywhere from 3.5% to 7%. On one property, it's not going to make that big of a difference, but you want to also keep everyone incentivized to keep your property moving forward. And he had the one we went with had a lot of creative ideas of how we could add washer dryers to the units. You get a different type of tenant profile when you start adding things like washer dryers to the units, and ways that he's been able to do it also on some of his other properties. He had some creative ways for us to kind of increase that overall income, that it just made sense for us to go one way versus the other. But it's you have to go with your gut on this, right? There's not any, you won't know until you really get into it, right? But I think the person we chose, their kind of history aligns more with my husband's history on growing up in the apartment business. And I think they similar mindset will also hopefully end with similar decision making when you come down to some of these hard decisions to make as a property manager or property owner.
So before we get into Utility Ranger, which I definitely want to make sure we get to, just one last question on the property side. So are you planning long term to sell everything in California and move it all to Florida, or will you just continue to manage it at long distance, until you decide to sell them? Sort of what's your plan?
I don't think that we know yet. I think that it seems like every other day we go back and forth on it because we feel like we have people chomping at the bit to buy them from us.
Mm.
But we have this kind of protected source of income, right? So I think until we can build up that same amount of income in a different apartment or buy additional apartments out here and kind of replace that income, then that would be a less risky to then transition those properties out here. I think there's also a lot of room for growth. The rent in California has become astronomical, and our 2 bedrooms have gone from $1,800 to $2,200. And once that really filters through the whole property, that's going to greatly improve the valuation of the property. So we want to wait it out a little bit unless there's a really great opportunity here that we can kind of pre-identify, and then we know we could sell those quickly on the back end. But right now it's kind of a protected source of income with the uncertainty of the economy right now.
Right. Okay, so all that out of the way. So tell me about Utility Ranger. So you mentioned that this actually began because of a problem that you were having yourself that you wanted to solve, which is often how great software companies start. So tell me what the problem was and what your solution was.
So being owners of 100 units, well, now 130 units, being owners of a smaller portfolio, our water rates, our sewer rates, our trash, everything was going up so much in California that it was really eating into our profits. So when I was in grad school, I was helping my husband with the management. I realized this isn't where I could be best utilized. I'm a problem solver, and the day-to-day management just didn't fill my cup per se. So I said, how can we fix this utility problem? This is the third largest expense on our books. And so we'd heard of this thing called RUBS, or ratio utility billing, which is a mechanism to transfer the owner paid utilities. And electric is very rarely in this unless you're in New York or the upper Northeast, but electric's very rarely in it. It's mainly master metered, like water, sewer, trash, pest control, all the things that you need on your property that get billed to the owner. We went to these RUBS companies, and almost all of them turned us away. They said, yeah, we do this all the time, but you're just not that big. We don't take people who don't have 1,000 units or more in their portfolio. So we were pretty frustrated. And my husband said, well, you want to get out of the operations. Why don't you go work for one of these companies, and we'll kind of backdoor our way in there, and maybe they'll take us on by default. And I said, oh, that's a great idea. So I went to go work for one of these companies in San Diego. We were about 100,000 in revenue. That company took off like a rocket ship. We had got to $20 million in revenue in that 5 years time span, and really came from like number 4 employee to having 70 employees. It was amazing. But what I learned was there's a secret behind this utility billing and RUBS. They of course took us on by default. So we put our first property on it. My husband was worried, like, are all my tenants going to move out? Like, what's going to be the reaction? I don't know if this, I don't want to be the first one on the block to do this, but I'm like, you don't want to be the last one on the block to do this. So we implemented on the property, and to my husband's surprise, nobody moved out. And in fact, we got a flurry of, uh, you know, work orders. Oh, I have a leaky toilet. Oh, I have a leaky faucet. All these things that they were not telling us about because they didn't want us in their units, because maybe they were hiding a cat or an extra tenant or whatever. But outside of just the savings from that side, when we went to go refinance our property, we had from the first year $36,000 of additional revenue, of utility reimbursement revenue. Well, it's about $1,000 a unit per year. So about $80 a month is what we were charging. And that was really what the bills were. But that $36,000 a year of additional revenue, when we went to go refinance the property, Freddie Mac valued our property at $1 million more just from that 36,000 of additional revenue, because you take that 36,000 of additional revenue and you divide it by your cap rate, which is that cap rate multiplier. And it's that increase of NOI. That 36,000 divided by a 4 cap that we had was $930,000 or something like that of additional revenue or additional asset value increase. And we were like, whoa, like, look, what does this look like across our portfolio? So we implemented this across our portfolio. We were able to increase our whole portfolio value by $2.5 million. We were able to leverage that additional equity, pull the money out, and buy more properties. And we said, this is not about utility billing. This is about creating a mechanism to grow your portfolio using forced depreciation. Right. And this forced depreciation model is every dollar you can increase on that NOI, you divide that by your cap rate. And so I always tell people the simplest formula is number of units times 1,000. So ours is 36,000. You divide it by your cap rate. And if you're not billing your residents for these utilities, that's how much money you're leaving on the table from asset value increase that you could leverage to grow your portfolio size. And so my sister at the time had 12 units, and she said, whoa, I see what you're doing. Like, take me on. I want to do this. And I said, I can't. You don't have 1,000 units in your portfolio. I became the people, that wouldn't service me. And so I developed this little calculator on Excel, and I gave it to her, and I taught her and her husband how to do a little mail merge with it. And they started using this on their properties and saw the same kind of impact to their asset value. And they were able to buy more properties as well. And I said to myself, how can I take this service model and turn it into a SaaS model? And for people who don't know software, SaaS is software as a service or a do-it-yourself software. And I said, there's so many owners just like me that are at such a disadvantage because these big companies won't help them. Like, how can I give them the same advantages these big players have been having for years and realizing their asset value increases? Like, the game's not fair. Like, how can we have that same advantage that the big guys have been having for years? And so, these big utility billing companies have kind of really made it seem so complicated, right? So I always say utility billing is about as sexy as doing your own taxes.
Hmm.
You don't want to do your own taxes because it's complicated. The regulations, there's compliance issues. You don't know what you're doing, but we've taken that model of like a TurboTax model, right? Like, how can we make it so simple that any day investor, whether you have a duplex, whether you have 10 units, whether you have 500 units, can do this themselves by sticking in your utility bills and clicking calculate and sending the bills off. And so that's what I did at the time. Post this one company I worked for, I got recruited to another utility billing company, and then got recruited into fintech and said, I don't like fintech. It's very challenging. And I just don't care if my payment goes through a half a second faster. Like, I was creating real value for owners like me. And that's where my passion was. And so then COVID hit. My husband I said, I can't do this anymore. I can't work for someone else and work on someone else's thing. I have this drive and this calling to help people like us, realize how they can grow their own portfolios. So my husband said, okay, I know you're having the dream. I said, so he gave me $250,000. I quit my day job and I started my own software company. And then about a year later, I was out of money and had half built software and my software development company. And I know exactly what I want, but I'm not a tech person. Like, I can't write code.
Hmm.
And so, you're kind of in this unfamiliar world. And they said, it's going to be another 450,000, another year to finish it. And I said, there's no way I can go to my husband with this request, right? Like, I've already quit my job. I've already taken a bunch of money. So I said, I need a partner. And I knew the reason, because I'd worked for these big firms, I knew the reason no one went after clients like me is because they don't know how to reach them. It's not like you're on, well, maybe now people are a little bit more advertising their units, but most people, this is a side gig for them. Like, they have their day job and then they own units on the side, and they may not be advertising that they own these units on LinkedIn necessarily. So they don't know how to reach them. And I knew you don't reach them by going to them individually. You reach them by finding a node. And I knew that node was Grant Cardone. He teaches everybody how to invest in multifamily real estate. I've been following him for years. So I pitched my company to Grant Cardone and Jared Yellen, who own 10X Incubator, and they acquired half our company on the spot. It was probably the most crazy day of my life. And they helped me raise additional capital, and we finished our product the following year. So this is the end of 2021. We finished our product in 2022. We launched it in 2023. And it has just been crazy since earlier this year. We're bringing so many people on board. People are finally, every time I talk to somebody, they're like, finally, a company who's going to help service me. Like, yes, I could use this. Any big player could use this, but that's not who I'm trying to help. I'm trying to help the little guy because no one will service these guys. And I don't want them to feel the same way I felt. I want to make sure that they have the same advantage and they have this as another tool in their tool belt when they look at, hey, how do I look at my value add strategies? Maybe I don't have the capital to put out on these properties. What other thing can I do to tick up that NOI and really hack that NOI to grow it so I can leverage that additional capital and grow my portfolio? So we're about 6 months in. We have a lot of new users on the platform. We're getting a lot of interest from users and Grant Cardone and their team. We just loaded their first property on it, and it's been amazing thus far. And it makes me feel so rewarded every time I meet people like myself, because I am my own client. I know exactly what they need because I still need it. And I said, okay, another 30 units with our new Pompano Beach property going on the software. And, that's why we started it. And, we're going to grow this thing, and it's going to be kind of our next big project. So it's great to not have the management side, working through that right now, so we can really focus on the growth of our new tech company.
Well, that's great. That's a really amazing story. I want to ask you who is your avatar for this? What's the kind of owner that you're really pitching this at?
It's people like me, right? It's kind of that owner who has under 1,000 units that they don't have an option really. There's a few companies that have maybe a billing module within their property management software, but it's not really compliant. There's so many pieces of this to remain compliant because like I said, I've done this all over the country now for the last 13 years working for service companies. You have to have invoices, and those invoices have to have what the master bills are on there. You want to make sure that the residents can reverse calculate how their proportionate share of that utilities came to be. And many of the softwares out there that are targeted maybe at the same market are just putting the charges on the ledger, and it's like a black box of calculation. No, invoice goes to the resident. They don't really know what's going on. They ask the manager, how is this calculated? They don't really know how to answer the question either. And so, you have a lot of people just kind of, oh, I'll simplify this and putting a flat fee on there. But that flat fee doesn't, it's kind of like when you go to a hotel and your shirt's a little wrinkly. What do? You put it in the shower or in the bathroom and you turn on the hot water and you let it go and you get the wrinkles out so you can go do what you need to do. But our tenants think the same way, right? And so, for example, I had a tenant at my 36-unit building when we first started this, and one of the residents called and said the neighbor was leaving her water on all day. When my on-site manager went in there, she found out her shower was on and she wasn't even there. When she came home from work, she said, oh, well, my dog has anxiety and she barks when I'm away, but if I leave the shower on, she won't disturb the neighbors. It's like it's that slight modification of behavior that's a big piece of this, right? So if you don't have a choice because service providers won't service you, and the softwares that offer a billing module make it too complicated, too many questions come your way that you resort to a flat fee, that's not really helping you. In essence, it's just a rent increase, and you have that same kind of behavior issue. So there wasn't a lot of people out there. So I wanted to kind of target that same under 1,000 units in the portfolio. They don't have a lot of options. Make a very easy, compliant software that's so easy to use that not only helps them elevate their NOI, but also helps modify the behavior of your residents so that they can start conserving on a property level and residents start taking accountability for their usage while not asking so many questions, because the bill that they get that they make a quick payment on, has all the information that they need, that then they're not bombarding the property manager of how is this calculated. So we tried to kind of address all these issues that I knew were in the market because I lived in that market. I live and breathe in the market. But yeah, the smaller owners. So it could be a duplex to 1,000 units, but I would say our core market is probably that, 1 to 300 count. But we have a bunch of, new users on the platform with duplexes, and we're just getting ready to sign on a new user with 800 units. So there's kind of a variety of anyone who can use this. If you're not doing it today, you need to be doing it today.
Yeah, I mean, it's interesting. We've done well with properties where we instituted RUBS and noticed that dual effect. Like, one, you're bringing in more income, but also people start using less water, right?
Mm-hmm.
As soon as they have to pay for it, it's like, oh, okay, maybe I'm not just gonna like run the taps because
I'm not
it's
just going to
costing me
load
money.
the dishwasher with one dish in it.
Yeah, exactly. So, well, listen, Tiffany, this is great. Really interesting, amazing story about how you started Utility Ranger. I'm sure there are lots of people who are going to want to reach out to you to find out more about it. So what is the best way for them to get in touch?
You can go to utilityranger.com. There's a contact us form on the website. You can also reach me on LinkedIn or Facebook, any of the social media platforms under Tiffany Mittal or Utility Ranger.
Awesome. Well, it was great meeting you today. Great hearing your story. And I look forward to following up and, so after some time has passed, to see how it's going.
Thank you so much.